Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Hello and welcome to the latest recording of Provident's podcasts. This morning we're here to discuss the healthcare M&A environment in 2023 and our outlook for 2024. I'm joined by two terrific guests here today to help me through this conversation. First of all, I've got my colleague in the New York office, Kevin McDermott, a VP in our team. Hey, Kevin, thanks for joining.
Hey, Scott, thanks for having me.
I also have Reggie Zachariah from Greenberg Traurig. Hey, Reggie.
Hey, and thanks for having me on as well.
Absolutely. Kevin, why don't we start with you, give a little background on the firm and yourself, and we can jump into things with Reggie doing the same.
Yeah, of course. My name is Kevin McDermott. I'm a vice president here at Provident. I've been with the firm now for a little over 3 years. At Provident, we focus on sell-side M&A advisory for founder and entrepreneur-owned businesses, as well as private equity-backed portfolio companies. We operate in several different verticals within healthcare services, including physician practice management, post-acute, behavioral health, and other services. We typically focus on deals between $30 and $500 million of total enterprise value. We have 3 offices in the United States. Our headquarters are based in Boston. We have another office in New York, and then we have a small office in Minneapolis.
Thanks, Kevin. And Reggie, yourself and the firm?
Yes, I'm Reggie Zachariah. I'm a shareholder at Greenberg Traurig in the corporate group, primarily focused on M&A. A majority of my practice is healthcare specifically. I've been with Greenberg Traurig for more than 12 years, and I pride myself in providing strategic, practical, business-oriented legal advice to my clients. And Greenberg Traurig is a full-service law firm. Our healthcare and FDA practice is recognized for handling transactional, litigation, regulatory, product approval, enforcement, and compliance matters for organizations across many diverse industries in the healthcare space. We offer clients practical know-how that comes with firsthand experience working in the industry and the regulatory circles. You know, I'm on the transactional side, but we have regulatory folks and we have folks kind of all over the place. And so we all work together when working with our clients. And I'm thrilled to be here discussing healthcare M&A with all of you today.
Great. Thanks, guys. And this is Scott Davis speaking, Managing Director at Provident out of the Boston office. I'll be acting as your moderator here today and chiming in with some contributions as well. But with that, why don't we jump into the content here? I think first off, we'd just like to take a step back and generally talk about our observations of the market. It's been a dynamic one, certainly for the last 12 to 18 months or so, I would say. And first, why don't we have Kevin, you can share some thoughts on the macro environment and kind of how that's impacting M&A.
Yeah, thanks, Scott. Dynamic is certainly one way to characterize how the market's acted in the last 12 to 18 months. We sit here at the onset of 2024, still facing some headwinds, but not the same resistance felt in 2023, certainly not the same resistance in 2022. The perception in 2024 is that interest rates will largely remain the same, if not steadily decline. Inflation has certainly cooled, as we've seen in the last couple months. However, there are still many rising costs that are still impacting margins and labor dynamics within healthcare services industries that remain a challenge for a lot of different services and sectors throughout the country. Because debt facilities are harder to come by these days, we believe that the allocation of capital and resources has become somewhat more efficient, but that also means higher scrutiny on potential opportunities within the market. And there's increased LP scrutiny on the asset performance and differentiation of assets in the market now. In addition to that, the continued cost inflation puts over-leveraged companies in a dangerous position, as a lot of these companies have had variable interest rate debt instruments attached to them. And in many instances, we're seeing across larger PPM platforms, some headwinds because of these larger debt facilities. But many PE-backed platforms continue to grow at a healthy pace and are still pretty acquisitive and focusing on high-quality add-ons and typically using less debt to finance these transactions.
Great. Thanks, Kevin. And Reggie, would love to get your perspective as well. I know you've got a very active book of business. Curious what your perspective is on the market, but also how or if that's impacting the types of engagements that you're working on. If you could chime in on that.
Yeah, no, would love to. And I actually have a couple of questions also for Kevin based on what he said. But look, we're largely seeing what you guys are seeing. And certainly the PE-backed platforms that were very highly levered with variable rate interest rate debt from a couple of years ago, they're having a difficult time continuing their acquisition strategy. And we're seeing some slowdown for some of those platforms. There is still a lot of availability of capital out there on the debt side. We are seeing private credit step in a little bit in places where traditional bank lenders may not be as comfortable and may not be as commercial as they were kind of in the past. And so there's still a lot of availability. It is more expensive, and it's led to a higher level of underwriting, which I think is good. And I think it's kind of the level of underwriting we were used to seeing, but it is taking a lot longer to get deals done. The add-on work is still really healthy. I think a lot of groups out there are still able to do add-ons, but the platforms, they're getting done, but they're getting done, at least from what I'm seeing, at a much slower pace and fewer and far between. There does seem to be some optimism in talking with folks that they feel that the rates are going to come down and that at least through the election, the economy will be fine and will kind of support their strategy. But I think there's more uncertainty, I think, with folks after the election on what could happen after that. But I think people are, trying to get as many deals done as they can while they still can. And the other thing I would say is with underwriting more difficult, especially on the debt side, we're seeing sellers not getting as much credit for EBITDA add backs. One of the things buyers will say is, hey, look, we can't finance what you're asking us to finance on this EBITDA, so we're not going to give you credit for it. And in terms of one of your questions, Scott, which is what other types of work we're seeing, we're beginning to see some refinancings. I'm not working on it personally, but I know that there's a couple continuation vehicles out there, but we are beginning to see some refinancings because of how highly leveraged some of these folks were. And so that is definitely a change from prior years. And because of the amount of leverage these buyers can get, we are seeing valuations continue to come down a little bit, but though I think that it's still a pretty strong market. I still view it as a seller's market if you have a really great asset out there that's of a good size.
Just double clicking on a comment you made earlier about EBITDA add backs and adjustments and getting credit for those. It was interesting. A couple of years ago, we saw sellers get a lot of credit for those pro forma adjustments, and buyers were willing to recognize those as a way to differentiate themselves in an M&A process. And now the script has kind of turned a little bit, whereas underwriters and LPs and GPs are scrutinizing those adjustments a lot more, not giving credit for them because the ability to underwrite those is just not feasible or a similar market as to where we were 2020 and 2021. So that's certainly a dynamic that has changed pretty drastically as well in the last couple of years.
I would agree with that, guys. And, whether it's a little bit of opportunism on the private equity investors to not have to pay on some of those pro formas and or added scrutiny by the lenders, I think it all adds up in this environment to just the lack of ability to get through the same magnitude of adjustments as we did in the past. I think we can probably all agree on that. But another point that you raised, Reggie, was around the pace of processes going on and the scale of processes, the idea of a lot of platforms simply taking this time to create scale and efficiencies in what is otherwise a slightly more difficult market to navigate. Kevin, on that point, we'd love to get your perspective on the pace of platform activity, the scale of assets going to market, and what our perception is against what the rest of the investment banking community is kind of putting out there.
Yeah, one of the most common questions that we received at the JP Morgan Healthcare Conference in San Francisco earlier this year was whether or not we were launching deals at the same pace as we were a couple of years ago. Our answer was absolutely. We remain extremely optimistic still about the ability to do deals in this environment. But I think a takeaway from that question, we were repeatedly asked by a number of private equity investors. It sort of led us to believe that a number of our competitors were either waiting on market conditions to improve, maybe there was an element of client underperformance or a lack of relevant or interested buyers for a particular asset. But based on just the services that we operate in, there's certainly a cyclical, non-discretionary nature of the healthcare deals that we work on that sort of insulates our clients from broader macroeconomic headwinds. So we remain pretty optimistic. And I think the nature of getting these deals done is also kind of going back to what we said earlier, not doing a lot of financial engineering and kind of going out with a defensible EBITDA number to make sure that we can get buyers comfortable with those adjustments and how we're presenting the financials, which also creates alignment on what the valuation expectations are and sort of closes that bid-ask spread between the client and the buyers.
Right. One offshoot from the call it lack of activity from private equity investors exiting these platforms, instead just using this time to bolster their bottom line and their infrastructure is how does it impact their ability to raise new funds, which of course is something they always need to have their eye on. So there's a little bit of a tug and pull as it relates to that. Kevin, what are you hearing from the PE world as it relates to that topic?
Yeah, so as far as fundraising goes, we've heard mixed things. One challenge has been a lot of private equity funds want to increase the size of their fund going into 2024 and 2025. For example, if there's a private equity fund that had a flagship fund of $500 million and they're looking to raise $650 million for their next fund, a lot of the LPs are not willing to contribute the same percentage as they might have in a smaller fund, and they want to keep their dollar amount the same. So that puts a lot of pressure on the GPs and private equity funds to go out and find new LPs to invest in the fund. And just given a lot of the current macroeconomic conditions, it's been quite difficult to kind of bridge that gap between current LPs and then finding new LPs to reach that target fund size.
Yeah, it makes complete sense. We're talking a lot about what we've seen in the past, call it year or so before we get to the go forward. What do we view as kind of the key drivers for activity in 2023? Obviously, a little bit of a tighter market, but what was sort of carrying the day as far as you saw, Kevin?
Yeah, Scott, there are a number of factors that propped up the healthcare services market in 2023 compared to a lot of other sectors like consumer or industrials. Investors still perceive healthcare services as acyclical. Payers and the non-discretionary behavior of healthcare typically insulates a lot of the sectors and clients we advise, including physician practice management and post-acute services, and other providers from significant changes in consumer spending.
Yeah, Kevin, look, I agree. And I will tell you, going back to your kind of last couple of points, we're seeing private equity groups who historically have not been interested in healthcare. They've gone out, hired healthcare partners, and now they're actively looking and they want to get into it. And it's just such a large part of our economy. And I think a lot of investors do view it as pretty acyclical. And so I think there's going to be a continued interest by private equity groups here in the space. And in terms of kind of other key drivers of deal activity, I'll tell you, we see a lot of groups who are very focused on reimbursement pressure. And it's both on the buy side and the sell side. And there's just a lot of discussion around reimbursement pressure and, how things are going to look as we continue to move towards value-based care. There's a lot of discussion surrounding Medicare Advantage V28 specifically and how it may affect earnings, how it may reduce it. And, look, there's a lot of patients in Florida, California, Texas, and these MA plans. And I think there is an expectation of lower reimbursement. And so certainly if you're a group who's thinking about selling, right, and doing a transaction, that could be a good reason to sell because you're not sure what the future looks like. All of this uncertainty, I think, really presents an opportunity. And so I think there's going to be private equity group backed platforms out there that are going to figure out innovative ways to deliver high quality care to their members. And I think there's going to be a lot of those folks who do very well. And for them, it's a great opportunity to also be a buyer out there and build out their organization and figure out ways how they can deliver more value-based care.
All makes sense, guys. Appreciate the thoughts on kind of the historical performance of the market. As we look ahead, probably most importantly here, curious to get the group's thoughts on 2024 outlook. I think obviously we've been wrestling with some issues historically. The world kind of has stabilized to some extent as it relates to funding capacity. It's the new norm. How do we think that impacts things on the go forward here? Also keeping in mind the fact that there is this kind of pending need to put capital to work on the PE side, as well as the fundraise, which is going to be based upon historical performance and exits. So all that being said, curious, Kevin, you want to jump in first, the outlook for 24 and beyond?
Yeah, Scott, I think we probably had a very similar outlook at the onset of 2023 based on the sectors that we operate in. Obviously, not every investor or banker or attorney felt the same way or is in a position that Provident was to have a successful 2023. But speaking with the broader market now, looking ahead in 2024, it seems like a lot more investors have expressed optimism for this year and expect deal flow to increase. I think after a somewhat muted 2023 in terms of both deploying capital and returning capital to LPs, there is an expectation now among private equity investors to put more capital to work and at the same time return capital to LPs. So we expect there to be heightened deal flow activity compared to 2023 based on those factors. And, there's still a lot of groups that are doing add-ons this year, as noted earlier in the podcast. And there's going to be a continued focus on portfolio company growth before an exit in probably the latter half of 2024 and then looking into 2025. Again, the macro environment is still facing some headwinds. Rates are at an elevated level compared to where they were in the last decade. But that being said, I think there is certainly a level of comfort now with the higher interest rate environment. And at the end of the day, private equity's job is to deploy capital regardless of the environment. And this is just a reality that they're going to have to deal with going into this year and be able to efficiently deploy capital across a number of deals. And I think one thing we've noticed as well, the quality of deal flow has increased compared to last year. I think the broader market sentiment was that there were a lot of, call it C to B type assets out on the market. And now we're seeing some of the premium assets return to the market and looking to transact. So we're excited about the quality of deal flow as well as the quantity and volume of deal flow going into this year.
Yeah, all makes sense. And if nothing else, I think we can take some solace from the fact that the Fed has signaled that there would be rate cuts this year. It's a matter of when and to what effect and how long it takes to trickle down to the M&A market. But also, I think a pretty solid indicator for optimism in 2024. And then, Reggie, to get your perspective on it, how are you seeing this impact things from the legal perspective? Any added steps or opportunities you're taking based on today's market, where we think the world's going in the future that you guys are leveraging?
Sure. I mean, look, I think we're kind of seeing a similar thing in terms of sentiment and what we view as the deal market in general. Going back to a previous point, underwriting is that much more rigorous. And so deals are taking longer. And not only are they taking longer, I think, in 21 specifically, right, and even 22, I think a lot of groups out there, they were doing acquisitions at a very quick pace, but didn't really have time to do proper integration. I don't know if you guys are seeing this, but we're seeing, even on the diligence side, we're seeing a lot more what I will call integration diligence than we have before. And because of the more rigorous underwriting, we're seeing, besides deals taking longer, whenever something comes up negative in diligence, whether it's the Q of E, the quality of earnings report, whether it's the legal diligence report, we're seeing buyers not just accept them, we're seeing buyers asking for more fulsome indemnity. If there's a legal issue in the quality of earnings, we're seeing buyers repricing deals a lot more. And I'm hesitant to say retrade because these are truly real issues. And so I don't view them as retrading, but they really are in a lot of cases repricing, where sellers, for example, may have not engaged a banker, or they engaged, a banker that didn't do a Q of E, a sell side Q of E, and said, hey, our EBITDA is X, and the actual Q of E when the buyer does it is 70% of X. Buyers are not just saying, yeah, we're going to accept it. They're now repricing, or they're coming up, I'm seeing an increased use of seller notes. I'm seeing an increased use of earnouts that are tied to ongoing and maintain performance post-closing. Obviously, with earnouts in the healthcare industry, you have to be very careful and make sure you're properly legally structuring those. But we're seeing an increased use of those now. And I think that's going to continue in 24. We do continue to see a lot of DHS issues with groups having to self-report. And so that, I think, is still fairly common. And to answer your question now directly, I think one thing that's really important is, for groups out there who are considering selling, to engage good counsel and engage a good banker and do a sell-side Q of E. Because if you can do a sell-side Q of E ahead of time, you can figure out these things, right? And you know this better than anyone. And you can start addressing them, you can start thinking about them. And then when you can go to market, you can actually go out with a good solid number that you can defend. In terms of structuring, you can clean things up, right? A lot of practices out there, S Corps, and there's all kinds of issues with S Corps and ownership and what you can and can't do. And there's just not a lot of flexibility. And so there's always a lot of surprises there. And so for the groups that engaged a banker, a good banker like yourselves early on, a lawyer to think through structure and what needs to be cleaned up, and did a sell-side QV, their processes have been going a lot smoother. The ones that don't, it's just been a lot more challenging to get those done, and they're usually not done at the LOI terms.
Yeah, totally fair. And that's certainly why, at least here at Provident, we're very much focused on making sure we've got a QV completed before going to market, and we've got supreme defense around our EBITDA figure. So couldn't agree more there. And maybe as we just transition a little bit away from the themes of 23 and 24 and get more specific around where we think people are going to be active on the sell side as well as the buy side. Would love to get the group's thoughts on those topics. Looking backwards, I think physician practice deals continued to be very active in 23, but what we definitely saw was a marketed shift towards service-based offerings, and this coming from the traditional healthcare service investors that, again, had been pretty focused on provider-based businesses and will remain to be the case to some extent, but certainly more of a shift, as Kevin noted, our JPM conversations thematically, kind of what are the services in and around the physician practice world that have the same tailwinds that can be played off of, provide the same opportunities, but maybe eliminate things like what Reggie alluded to earlier, reimbursement risk. So at a very high level, I think that that's a theme that we're seeing. But maybe, Kevin, if you could chime in with specific areas of subsector activity as well as where we're focusing at Provident, I think that'd be helpful.
Yeah, for sure. So there are a number of assets and specialties that we think will remain pretty active and bullish throughout this year. On the provider side, we believe that specialties that facilitate the shift to or have a lot of value-based care upside are of high interest. These specialties include cardiology, primary care, and orthopedics, as well as pain management. And then, as you alluded to as well, a lot of investors are looking to gain access to the specialty and provider ecosystem without actually relying on any reimbursement. So services in and around physician practice management or ORs or hospitals or things like that. In addition to that, payer services is also becoming a core focus for a lot of investors. The trends driving this investment thesis in payer services include the continued rise in healthcare costs, which I think we have all observed being here in the United States and working in the healthcare ecosystem. We're seeing investor interest peak in a number of different payer services sectors, including revenue cycle management, cost containment solutions, medical review, IT services, and TPAs, as well as services that kind of penetrate into value-based care as well, and services that have some sort of regulatory backdrop too. And then lastly, pharma services remains a very, very active sector among healthcare services, including CDMO businesses, which are contract development and manufacturing organizations, clinical research sites / CROs, commercialization services, and anything that really has an outsourced pharma services component to it, we remain pretty bullish on. It offers investors a pretty unique opportunity to capitalize on a lot of strong long-term tailwinds of the pharma services space. And these services, their clients and customers are large pharmaceutical biotech companies, and these are very cash-rich clients that a lot of these services can benefit from. And it seems like every year there is a major shift from a lot of these pharmaceutical businesses doing work in-house and then contracting with third parties that can do some of these services more efficiently, like clinical research. So those are a couple sectors that we think will remain very active this year. And those are all sectors that Provident remains active in as well. And we advise a number of businesses with similar profiles as the ones that I described.
That's great. And I know, Reggie, in speaking to you in advance of the conversation today, you mentioned a shift in terms of the buyer landscape a bit, more and more impact from some outside the box investor groups. What would you say about that topic?
Yes, I mean, right. Historically, most of the buyers in the space were private equity backed, and there would be hospital systems who would be a potential buyer, but usually they just weren't very competitive price wise. But now we're seeing hospital systems and health systems much more active in this space, and they're lobbing in competitive bids, and they're sometimes outbidding private equity. And so I think that's a good thing for sellers. And I think you'll continue to see those groups get involved. And so I think, look, that's only a good thing for sellers because they'll have more competition from buyers, which should increase price.
Yeah, absolutely right. On the sell side, we're more than happy to have more serious players involved. To your point, historically, hospitals and health systems really haven't been able to keep up, at least on the valuation front. So to the extent there's a shift in that, we'll welcome their participation. So that's great. Good. Well, I think we covered a pretty wide range of topics. We could probably go on for a considerably longer, but in the interest of time, want to just thank you guys for participating today. I think hopefully what our listeners took from the conversation is a good understanding of where we've come the past 12 to 18 months and the kind of dynamic changes to the market, and hopefully some reason for optimism on the go forward for a loosening of investor community and ability to fund transactions, fundraising, and the like. and also some themes around the areas we think will be most active and some impacts to the processes to be run. So with all that being said, I think I speak for everyone when I say contact info will be available alongside this recording. More than happy to speak about the content of this conversation or anything else that we can assist with and really serve as a source of education to the listeners first and foremost. So again, thank you, Reggie and Kevin, for the time today, and appreciate your efforts.
Thank you, Scott.
Yeah, thanks so much for having me on.